There is a difference between participation and positioning. Positioning is the path to strategic growth. 90% lose because they misunderstand the game. They believe trading is about prediction. It isn't. They think success comes from the perfect strategy.
The market rewards structure, not excitement. Positioning beats prediction. Patience beats activity.
The 10% do not argue online or seek validation.
They stay silent because they are compounding. The power of growth is in the reinvestment.
Most people enter trading with the wrong psychological foundation. They come for freedom, speed, and financial escape. But they bring a mindset built for employment, not markets.
In jobs, effort increases income. In trading, it increases exposure.
This is where most traders quietly start losing.
They lose not in charts, but in expectations.
Markets operate on probability, liquidity, and positioning.
Institutions deploy capital strategically, not emotionally. Retail traders deploy capital reactively to market movement.
Respond to motion or prepare for structure. The choice is clear. Choose structure.
They confuse motion with opportunity, and it becomes expensive.
Knowledge without structure turns into destructive noise.
Institutions do not wake up and guess trades. We execute structured strategies with clear levels and risk zones. They never risk capital to feel busy or productive. Discipline chooses to wait. Retail traders focus on entry first, risk last.
Smart money studies liquidity where stops quietly accumulate.
Retail traders chase momentum after expansion already happened. The candle slows and dims, but the businessman remains steady. Markets move in structured cycles, not random chaos. Observe the cycle: accumulation, expansion, distribution, retracement. Large capital leaves footprints through consolidation and liquidity sweeps.
Most traders react to candles instead of structure.
By the time emotion appears, positioning has already occurred.
This is why most traders always feel late. The most powerful concept in trading is risk management. Amateurs ask how much they can make. The wise watch the trends and stay composed. Professionals ask how much they are willing to lose. A stop-loss order is your disciplined way to define that limit. One undisciplined moment can destroy months of progress.
Over-leveraging, moving stops, revenge trading, psychological leaks. Trading is not intelligence, it is emotional control. 10% build systems to protect themselves.
90% rely on willpower, and it fades. Winning traders think in quarters and years, not days.
Consistency comes from statistical edge, not single trades. Compounding looks boring, but it is powerful.
Small gains and controlled drawdowns build stability.
Impatience, not small capital, is the real problem.
A small account needs preservation before expansion. Discipline is mechanical, motivation is temporary.
Winning traders build strict rules and defined limits. A daily loss limit caps potential damage. Weekly exposure remains stable.
They trade less, but with greater intention. The future trader must think strategically, not emotionally.
Markets are becoming more algorithmic and data-driven.
Algorithms execute faster than human reaction time. But machines cannot replicate patience and judgment. The future belongs to structured and adaptable traders. The future belongs to structured and adaptable traders. Emotion reacts, systems respond. Observe the mechanism's steady calibration, a precise alignment of variables. Impulse destroys, discipline compounds. The market is not your enemy, inconsistency is. Profit comes from alignment, not excitement. Wealth in markets is created through discipline. The majority chase movement instead of mastering positioning. They seek speed instead of sustainability. They trade for excitement rather than edge. Excitement fades, but the edge is what endures.
The 10% build systems before placing trades. First, establish your risk parameters. Then, confirm your entry. The 10% build systems before placing trades. First, establish your risk parameters. Then, confirm your entry.
They define risk before defining reward.
They remain emotionally neutral during volatility. Observe the strong, rapid swings of the market. Yet, he stands centered and stable.
Wealth grows through disciplined repetition. Compounding transforms small actions into great success.
This is calculated positioning, not gambling.
This is probability management, not prediction. We structure risk and reward.
Welcome to the mindset of the 10%.
If you shift from reacting to structuring, everything changes.
If you move from chasing to positioning, outcomes improve.
If you replace emotion with execution, stability follows.
The shift is psychological before it is technical.
The market tests discipline more than intelligence. Your systems determine survival, not your predictions.
Those who evolve with markets continue to survive.
Those who remain static struggle over time. Silence protects growth in a noisy market environment. Welcome to Finance Hustle, where structure wins.